Sanyal, the global strategist at Deutsche Bank, joins us. Good morning, Sanjeev. Thank you very much for joining us and dropping into the studio. What have you made of the rate cut? Is that even a first step for the healing of the Chinese economy? And in the first place, is the world overestimating the Chinese slowdown?
I think what you're seeing right now is precisely what I've been speaking about for several years now, which is that China is now shifting out of its investment-driven growth model, and as it shifts out of that, there is a huge amount of capital that is releasing and flooding the rest of the world. So as it cuts rates, this may smoothen the transition a little bit maybe, but it will not really resolve the problem, which is that China will continue to slow down, its investment rate will continue to decline, and capital will keep flooding out and flooding the world, which will keep the global cost of capital low, irrespective of what the Fed does.
Okay.
So do you think the global economy or investors are right in estimating that demand from China, whether it is for consumption goods or for commodities, is going to continuously decline? Because that seems to be driving the mayhem in other stock markets.
I think the fact that China's investment rate will keep declining and will keep declining over the next decade or more, I think is something that is that I've been talking about for a long time. So I am not at all surprised by that, and by the fact that China's demand for commodities is consequently also slowing down. So all of that is not surprising. The question now is, who in the world is going to take this huge amount of excess capital and begin to invest that? That will bring back the demand. And really, in the end, I mean, a country like India may benefit or whatever, but really, ultimately, it's got to be the US which should be willing to take at least a significant part of this excess capital and put it into investment activity. If that happens, the world will again return to massive global imbalances, but at least we'll get growth. But on the other hand, if it doesn't happen, then we'll slosh around in this environment of low demand, cheap capital, and continuous bubbles appearing.
How does India get impacted in all of this, Sanjeev? Because what we have been left with after the devaluation of the yuan is a very big competitive disadvantage. From here on, how do you see things shape up for India?
I think short-term, obviously, any global uncertainty slowdown is not good for India. But if you're taking a somewhat longer-term perspective, a prolonged period of cheap capital and cheap commodities, both of which India needs from the rest of the world, is good for India. So really, if you look past this period of turbulence, potentially India could benefit from this by using this period to go out there and really build up its economy. So it requires, however, a lot of economic leadership, policy leadership, in the sense that you now need to begin to reform the economy in a way that allows a big construction boom, investment activity to pick up again, and so on. And of course, that in turn requires the banking sector to be reformed and the cost of capital to be structurally brought down. The rest of the world will fund us to do a lot of this, but we have to take, the onus is really on us to take on the job of reforming the economy.
Okay. Sanjeev, how are you looking? Let's look at some numbers, actually. What do you think the yuan could do? Some people say that it could even go to 7 before the year is out. What's your reading?
I think, first of all, let's be very careful about what we mean with how we interpret this so-called crisis in China. This is not an emerging market crisis in the sense of Argentina. You're talking about China, which is a huge creditor country. It has enormous reserves, and internally also it has a lot of resources. So this is a structural shift. This is not an emerging markets crisis. China can defend its currency for a long, long time, given the amount of reserves it has.
So Sanjeev, the question is, in nobody's mind is that China is weak in terms of defense. The question that's occurring is that, will China use the currency to prop up more demand for its factories? Will active yuan depreciation be a policy?
I don't think this is a. There may be some pressure that they're releasing, but it is not the case that they are structurally going, keep devaluing, because they are entirely aware that given how large a exporter they are, they can't grab market share by making themselves competitive that way, in that particular way. You know, a small country can devalue against the world and get away with it. China is the world's largest exporter. It can't, you know, get away with doing that. So I don't think that is what they're attempting to do. What they will, you know, they have the resources of defending their currency, or at least stopping it from, you know, sort of going anywhere in that kind of collapse kind of way. So I think that is not what's about to happen.
So your dollar yuan guess would be what? At the most they go to 6.5 in 2015?
I think there will be at most a small move. The real issue is a completely different issue. Okay. The real issue is a continuous decline in domestic demand and investment activity, and the problem that there is an enormous amount of historical misallocation that they are carrying with them that they need to clean up. But when they clean up, obviously the lending process will also slow down even further. So really, this is about resolving the domestic demand, domestic investment trajectory in a circumstance where you know, they are saving and investing half their economy, and you have a situation where there is enormous overcapacity in every sector. The labor force is already shrinking. Population will soon begin shrinking. So this is really about managing that transition to the next phase.
Finally, then, before we let you go, do you think China's monetary easing would put pressure on the Reserve Bank to cut rates earlier than the September policy?
Well, it helps that the rest of the world has even cheaper capital than before, but ultimately the Reserve Bank has had, you know, the domestic circumstances should dictate this. My view has been for some time that the Reserve Bank has plenty of scope for reducing interest rates. The wholesale price index, as you know, is in negative territory. The CPI is, you know, not very high. I think it's other than onion prices and a few other food commodities, there is no domestic demand-led pressure on inflation. I think there is scope for very large declines in interest rates. Not small ones, but large ones.
Sanjeev, given your assessment of Chinese economy and its ability to consume commodities, how long, how many years do you think this commodity down cycle could last? I mean, steel is at, what, $320 HRC for how long now? 2 years, 3 years?
No, I think you are misinterpreting. This is a structural shift. You're talking decades from China. The question is, who in the world will take this on?
Fair enough.
You know, what you're seeing here is not dissimilar to what happened in Japan in the 1990s. It's shifted from being a high investment economy to a slower growing, lower investment economy. So this is a structural shift. Now, what happened to commodity prices then depends on what happens to the rest of the world.
Absolutely.
I mean, does the US take on the onus of investment? Does India do it? That is what is
Alternately, how much of this capacity is actually shut down and mothballed? Point taken. Sanjeev, Sanyal, a pleasure speaking with you. Thank you very much for putting this Chinese jigsaw into perspective. We're speaking of a structural shift, and therefore commodity markets and commodity exporters better watch out, and likewise commodity producers in India better be prepared for the long